This is Don DeBartolo, a senior commodity broker with Daniels Trading in Chicago. I am also the editor of the Trade Spotlight advisory service. Trade Spotlight is broken into three segments: the Trade Spotlight Futures, Trade Spotlight Commodity Options, and Trade Spotlight Future Spreads. This is the Beyond the Spotlight video, a video that spotlights two or three markets that may become trading opportunities for the week ahead. The week in question begins with Monday, February 4th, 2019. Before we get into the charts, please take a moment to read through the risk disclosures. Just pause the video, read through, just so you understand the risks involved with futures and commodity options trading. This is what you can expect from the Trade Spotlight advisory service. It's an email service. You'll see the timestamp, a write-up on the formation or pattern, the entry order with the precise entry price, the margin requirement if necessary, if it's a futures contract writing an option or a future spread, the stop loss and target price, again whether if it's futures options or a future spread, so you know the risk reward parameters before putting on the trade, and a link to the chart. Okay, let's take a look at our first chart for today. It's the April 2019 heating oil chart, and there is already a position on through the Trade Spotlight options, long the 195 call option, short the 2 even call option. It's a bull call spread. But I want to take a look at this chart again for a potential futures opportunity. So if you see here, I have an inverted head and shoulders formation drawn off. So this trend line that cuts across the left and right shoulder is a potential resistance level. A break of that level triggers an entry to the upside. So this high right here from this is Thursday, that's the 31st, was 192.01. So a break at that level would trigger an entry to the upside. You can see Friday the market bounced off this 20-day moving average at 185.57. So that was a nice support level there. Down here we have the MACD is a bit flat. That's the trend indicator, and that's obvious by this formation where it's been flat minus this dip here. This is going back to the end of November. The momentum indicator stochastics is showing an uptick in momentum to the upside. So if this resistance level could be broken, there could be some momentum behind this move to the target, which is essentially this Fibonacci retracement of this big sell-off. The 50% Fibonacci retracement price is 232, but I would place a target at the 2000 even price level, or maybe just in front of it. Potential stop loss would be below this pivot point low. That's a lot of risk in heating oil. Below this 20-day moving average is another option. That's at 185.57 again, but again that's a lot of risk, so perhaps just a dollar amount and trail that stop loss in what could be a very volatile market. Moving on to the next slide here, this is the July 2019 Chicago wheat chart, and I've got a couple things I want to point out on this chart. First, I circled off last year's chart action, so you can see here this was the middle. This low here was from the middle of January the 16th at 495.5, and by March 7th the market was up here at 579 even, so a good 80 cents or so move. So we'll look for this chart pattern to replicate that move. There's a trend line I've drawn off here. It's also a flat bottom triangle, although it's not clean because we have this activity in here and this activity down here. So it's not a clean formation, but so far this trend line is acting as resistance with 3 points. The first one being at 580 even, then 549 even, then 540 and a quarter, and then a couple points down here at 519 and a quarter and 517 even. So I would wait to get long this market only on a break of this upper trend line. You can see down here the 50-day and 20-day moving average are converging on each other. A crossover would be another bullish signal, but right now the market's pretty condensed in this area, so I would only get long on a break of that trend line. You can see the MACD, the trend indicator, is flat, and the stochastic indicator is just hooked over with some potential momentum to the upside. Short-term upside target could be these two highs on this trend line, and stop loss would go below recent contract lows. And the last chart for today is the July 2019 cotton contract. And this was actually a nice breakout to the downside today, breaking this lower trend line. An aggressive trade is to short on today's low and keep a tight stop and trail it down, maybe down to this 50% level that I'd drawn off. This is a Fibonacci retracement of this sell-off here that started at the beginning of December into the beginning of January. That 50% mark is 75.36. The market closed today, I'm recording this video on Friday, at 76.21. So there's a potential of about 90 points there, but I'm more interested in this market for a trade to the upside. So I have a potential left shoulder and a potential head. I'd be looking for a pullback down into this 50% level to actually form the head. This would be the resistance level, but to form a head here as a head and shoulders formation, or even this could just be a 1, 2, 3 bottom formation. That low that you see highlighted here is the 12-month contract low at 73.75. That was put in, 73.49. That was put in on January 3rd. The last time we were down there, this level was December of 2017. So that's a 12-month contract low. So a pull back down to this level, not surpassing this number 3 point, would be ideal, setting up the number 3 point, and then look to trade this opportunity back to the upside. I'd also like to see the momentum get back to the median level and hook back over. Right now you see there's momentum to the downside. Like I mentioned, aggressive trade would be to short this contract on a break of today's session low. And right now the MACD's kind of mixed, which is the reason why I'm not looking to short this contract right now. So I have a 20-day moving average angled upward, the 50-day moving average moving downward. A crossover of those two moving averages is a bull signal. So we'll be patient on this. This might not set up a trade immediately for early next week, or perhaps late next week. If we get that pullback in this level and the market begins to hook back up with the momentum hooking back up, there could be a trade opportunity. I've listed my contact information if you have any questions about the charts I put up today or just the markets in general. My local number, my recorded cell, and my toll-free number, or feel free to email me directly at tradespotlight@danielstrading.com. If you're not a subscriber to the Trade Spotlight advisory service, I encourage you to do so at danielstrading.com. Click on the Advisories tab up at the top, and then select Trade Spotlight under the Technical Analysis section, and you can take a look at all three segments, examples of all three segments, and FAQs on all three segments, and subscribe. It's a free trial for 90 days. After 90 days, if you want to continue to receive it, you would be billed $99 quarterly. Clients of mine, of Daniel's Trading, receive this advisory service for free. So if this is something you're interested in, you want to open an account, I can help facilitate that for you. Just give me a call or shoot me an email. Thanks for taking the time to listen to me, and happy trading.